Hello everyone, welcome. As I promised, a repetition of advanced moving average webinar. This time hopefully will not be caught with doing some live analysis instead of the actual webinar topic. It was enjoyable last time, I will say it was enjoyable. Sometimes like a pure interaction it's more important than just going through some theoretical stuff or just me talking out loud and etc. It might be more helpful having interaction instead of just going through the slides. So as usual, I would like to make sure that you can hear me and see my screen as well. So I would appreciate the feedback in regards to the audio. Our question box is there for you to stick in anything you want, but I would try to first of all make sure that you can hear me. So please, confirmation will be more than great. Hello, Coquetto. Hello, Zoran. Welcome once again. Welcome, everyone. So webinars@agfm.com, email address. If there is anyone that I haven't replied from me that address, please let me know. So before we start, I need to go through. Thank you for confirmation, everyone. Thank you. So before we start, as usual, I need to go through the disclaimer warning, just to remind you that this is recorded. This webinar is recorded. So this time you will receive a recording into your inboxes. Last time it wasn't, as I said, I will end up with live analysis. So I didn't send any recording. Also, I have uploaded the handout section, and the handout section, the PDF version of these slides. So let's do this. Disclaimer. This material provides general marketing communication for information purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as forex and derivatives may not be suitable for investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. Please read the full risk disclosure on our website. So let's do this. And that's me. Let's move on. Advanced moving averages. So this time it will be the advanced moving averages. So guys, as just briefly, a bit of a reminder, I don't know how many newbies we have over here. Everyone is welcome. So that's why I need to go through the bit of basics just to make sure that we are on the same page. Moving averages. So a bit of a, it's a newbie, okay. Never used moving averages. So how long are you trader first of all? Have you started trading? Are you still in a demo account? How long it has been since you started studying financial markets? Trading for the past 3 months. Okay. Before start trading, did you study the financial? Have you studied the financial markets? Have you used, how long you have been in a demo account before you passed to a live account? Okay, so, okay, for a month, and you used YouTube for learning, why not? Yes, videos are a way to, sometimes are more effective than actually written word. Good, okay, and how are you doing so far? I'm not asking about profits, but in general, do you feel that, do you understand what's going on? Do you feel that you have, so far you're doing good, you're doing bad, mixed? Okay, enjoy it, but at times get stuck on entry. You have made it. Okay, fair enough. So you got stuck on entry. You mean on finding, identifying an entry? So you are struggling to find a trigger point? Interesting. Okay, one more question because I don't want to delay everyone else. What are you using so far? What kind of setup you're using for your trading? Using moving averages, for example? Are you a price action trader? I mean, what do you have on your MT4 or MT5? Okay, so you do use moving averages and the trend. Okay, okay. So I guess you're struggling to find support and resistance levels, I guess, because this is where the entries are spotted. Okay. Okay, good to know. Okay, let's do this. It's by the way, I will warn you, Coquette, so that this is an advanced moving average webinar. So hopefully, I don't confuse. It's not my intent to confuse you, but it's a bit more. I don't know how you feel with moving average, but it's supposed to be a more advanced webinar with a bit more complicated um, moving averages. Okay, so hopefully. If you feel confused, okay, it's better um, to just, if you feel confused, it's better to have also a look on my basics moving averages webinars. Everything is on the past webinars page. Yeah, okay. So, you are aware of exponential moving average. Perfect. Perfect. So, okay, let's do this. Okay, guys. So, moving averages. Statistic comes from statistical analysis. Okay, pretty clear. It's a series of average values. That's why it's called moving average. Average values of different subsets of the full data set. In this case, in our assets, by saying data, we are referring to the historical prices, to the previous prices. So it's the average values of the previous prices of average prices of the asset, and that's what that with a particular formula we're getting the we are getting actually a natural complement of a 20 time series interpretation. This is a time series interpretation, right? What we are seeing, for example, is Aussie plotted per time and prices. So moving average Um, a moving average is actually give us the average values, in this case of Aussie, over time, okay, plotted over time, as I said, with a line, a natural complement to any time series interpretation. A moving average is actually smooths out, can smooth out the noise that we are seeing over here, the noise of the ups and downs, It smooths out. Let me delete all this just to show you, just to put a moving average on. So moving average smooths out all these noise, ups and downs, with a line, okay? So it could be used everywhere, in every single asset, in the long term, in the short term, everywhere. But obviously it needs adjustments, okay? It needs adjustments based on the time frame that you're using, the asset that you're using. Some assets are more volatile than others, so more the noise, you get more the noise. So they need adjustment. We're gonna see it in a bit. So actually, okay, you will say, but you're saying the same thing for everything. I don't know whether it's the most popular, widely used tool, but it's moving average. I mean, everyone knows about moving average, and nearly everyone is using it, excluding price action traders. But even them, sometimes if they had to stick or use an indicator, the very first thing that they're gonna do is use moving averages. So widely used by technical analysts, stock market traders, stock investors, why not? Yeah, I cannot really spot it. I don't know anyone that is not aware of moving average as as a prime tool, as a very first tool that everyone should start from, because many other indicators are based on moving averages, like MACD. Okay, they are based on moving average. So yeah, and in regards to reliability, even though we shouldn't compare, we could say that compared with other indicators, it might be the most reliable one. Okay, obviously, indicators are indicators. They are not gurus predicting the futures. They are giving us a guidance. Okay, they have their errors like every other indicator, but um, um, they can be used, if they used properly, they can be very useful on spotting direction, change of sentiment, support and on providing support and resistance areas, and so on and so forth. Yeah, it's I think it's the oldest tool. Sorry, let me get back to, if I'm not mistaken, it's the oldest. It's the oldest indicator ever, 1901. Let me just check, double check. Yeah, it's the oldest tool, as I can see from my notes here. The oldest tools in the field of technical analysis, originally published by a mathematician, Mr. Hooker, in 1901. So it was, back then he named them something else. He named them instantaneous averages and not moving averages. So the phrase was changed um, uh, 8 years after by Yale when describing Hooker's process. So yeah, the oldest tool, the oldest tool. So let's move on. Technical indicator, as we said, providing and presenting the average values of an asset over a given period, smooth out the noise otherwise. However, I should highlight at this point that is a lacking indicator, okay? Remember, it's based on the past values, such as the high, the low, the open or the close prices, or even volume. It could also, if you select, it could also, we could also have the moving average of the volume. So it's a lagging indicator as is based on past values. However, the fact that it has been designed to smooth out the noise, I mean noise, remember, if we just strictly focus on the price actions, we'll see some random price fluctuations and etc. So what it does is it gives us it takes all this movement, all this price action, all these fluctuations, and provides a line. It's a smoother version of, let's say, OSI over here, okay? Which could be well used as, I skipped some slides, did I? Yeah, I did skip some slides, sorry. This is the next slide. The fact that it smooths out the noise, okay, based on the assumption that the past performance can inform future performance, helps the traders, the investors, in general, the market participants to, can I say, predict the future? Not really, but at least to go as closer as they could in the potential next area retested from an asset. Okay, so central role, because history repeats itself. Okay, history repeats itself. So determining the past price trends, okay, helps us to find potential area that will be retested, okay? So in general, markets are very volatile and unpredictable sometimes, right? Which is, okay, we always find the reason why a sharp move was seen, okay? But yeah, general financial markets are very, very volatile, sensitive to news, sensitive to politics, sensitive to the sentiment, because it's all about the sentiment, how the market participants consume, understand the news, either this is an economic news, either this is political news, even this is a geopolitical news, and so on and so forth. Okay, so the fact that the financial markets, each of one of those assets that we have out there to trade, are volatile, either in the stock, I'm referring to everything, right? Stock market, commodity, metals, energies, currency market, etc. The fact that they are volatile and sensitive to some factors, that they are actually the key drivers of their prices, force the market participants to look for any advantage that enables them to reduce risk and increase the likelihood of profit, right? The target is to profit. So the fundamental assumption of technical analysis holds that past performance can inform future movements. That's why moving average play a central role in the determination of price, of past price trends. Now, the very basic one is simple and exponential moving averages. And the more advanced ones are variable moving average, weighted moving average, displaced and center moving or center moving averages, the adaptive one, the Hamming one, the modified one, and the volume adjusted one. Each one of all the ones that I have listed, they are just different kinds of moving averages. So different, they are based on different calculations. Okay, I'm not expecting to know or use all of them. We're gonna try and explain each one of them separately, but if something is way too confusing, just don't use it. If you don't understand it, don't use it. Try it in a demo account, see whether your asset might be satisfied better by a Hamming moving average, by a volume adjusted moving average, etc. But if it doesn't make sense to you or you're struggling to understand it, don't use it. That's why Koketsu, I mentioned that is a more advanced webinar. If you feel it's too much, don't forget it. Go back to the other past moving average webinars that I have presented and start with that. Okay. So, okay, all of them do the same thing, right? They help us to find the direction and the slope and the direction, okay, and the direction mainly of the asset and whether a trend is running out of steam or and is about to change. So, and obviously we can get this information by monitoring the slope of moving average lines and how the moving average lines interact to each other. Okay, this relationship, and also something that we also monitor and is key is the relationship of our moving average lines with the present data values, whether it's below the price, it's above the price, and so on and so forth, because each one of them means different thing. Just a second, sorry, I just got a message. So, as I was saying, a simple moving average, the one that all of you currently using, I guess, or the exponential moving average. But let's start with simple moving average. The simple moving average, it is what it is. It's actually the moving average of our past the prices over the time that we chosen, over the number of time periods that we have chosen. So it's finding moving averages. So, okay, obviously you don't need to good, Cocket. So obviously it's nothing bad on knowing the formula, but everything is done automatically in the MT4 and MT5 in your platform, so you don't really need to you don't really need to remember, let's say, the formulas. It's just to give you a feeling, an understanding of how each one of those works. So simple average is the simple moving average, and actually it's the average. It's the average value of our asset over time. So it's calculated by adding the closing prices by default. The platforms are using the closing price for a given number of time periods, and then divided by the sum of dividing the sum by the same number of time periods. Okay, and that it gives us either a positive or a negative trend. So over here, for example, is 1 hour moving average in US oil, simple one, and it gives us this red line. The red line is the 200. Let's do it in. So what I plotted over here is the moving average of the hand. Let me just put the simple one. Sorry for that. The simple moving average 200 day simple moving average for Aussie dollar. Okay, so what do we have? Which time period we have? Daily chart. How many days? What's the average value? The average value is based on the past 200 days. So today, the fact that I have seen my moving average here, it means that the formula automatically took into account the previous 200 days, found the average value, and I have a tiny spot over here which was connected by the previous days moving average and the previous days moving average and the previous, and it's plotted with, connected with a line. So every day we're getting a new number and automatically connected with our moving average. So why this trend, this red line that I put on, this 200-day simple day moving average is for? So as I said, it gives either a positive or a negative trend. What that's supposed to mean? It's positive if it indicates that our asset is in a rally or is about to to start an uptrend. It's negative when it indicates that our asset is in a downtrend or is about to fall. Okay, so that trend, this by plotting this moving average, simple one, exponential one, whatever. What's the key here is the fact that we are getting and we have an overall picture of the market. Okay, the larger the time period, the less volatile the simple moving average line is. Okay, a lot of traders are back to 89. Brian doesn't lose. It's time, and he wants me to check gold. Is gold falling back to 1890? Unlikely if the asset managed to hold above 1950, Brian. As long as we don't see this 1 month ranging market broken to the downside, 1890 is not an option. Okay, it's well supported by fundamentals, still well supported by technicals as well, even though I don't have any technical indicators over here. But this correction, it looks just a correction for the time being. So as long as it remains above 1950, which is not a random number, it's not a random support level, it was a support on this latest swing low that we had, and it used to be a resistance level from actually the whole August and September. Okay, the whole August and September, and look at this. It used to be also a key resistance level back in December in 2022. So as long as the asset holds a move above it, and we don't have a decisive fall below it, and a closure below it, so a confirmed fall below 1950, there is no indication that 1890 will be breached. And if you use your Fibonacci levels as well, you'll see that we haven't even, it retests the 23.6 Fibonacci level, which is a very weak Fibonacci retracement level, but still above it, and 1890 somewhere here, well below it. So that requires a decisive breakout and move and a strong selling pressure below 1950. Okay, that replies to your question. So intraday is negative, but overall is neutral, bouncing between 1950 and 2010 territory for a month now. Okay, let's get back to the webinar. Okay. So a lot of traders are quite skeptical on the simple moving average. They don't use them. They're very skeptical because, as I said, it's a less volatile moving average line. But in some cases, you can see that your asset is been well satisfied by simple moving averages rather than exponential moving average. So everything depends on your asset and your time frame. Test. If simple moving averages are giving you very delay or not accurate signals, then try exponential moving average, or then try different time frame. So for example, in my Aussie over here, 200 long-term moving average. Okay, so as we can see over here, it's pointing lower, as well above the asset. So it's not so helpful for us in a daily chart. Let me detect it to 100 to see whether it's the period that I have done that is way too is far away and doesn't give me an appropriate resistance level, or whether it's the version of moving average that is the thing. Okay, much better, but as you can see, it retested it many times, even broken it, and so on and so forth, and broken it today as well. So let me try the exponential one. Still the same exponential, and we'll get it back to 200 to see with okay, retested, boom. Found some resistance, but it broke it eventually. Okay. $100. Very sensitive, very sensitive. Okay, the exponential looks to be a better one. However, retested several times, but it provides a more immediate resistance level. And is flattened a bit, indicating that there is a bit of a neutral in the long-term outlook for Aussie over here. So let's see everything in a bit. Just to cover the exponential movement is more weighted moving average. So it gives us a greater significance of the most recent data points. So what that's supposed to mean? It means that it is very well used for short time frames, because it's giving us is based on the most recent data points. Okay, is weighted moving average, and as such it is more reactive to recent price changes than the simple moving average. So usually you can see in short time frames such as 30 minutes charts, 1 hour chart, you will see that an exponential moving average is used because it gives more sense. Okay, so this has the potential, the exponential movement average has the potential to help you avoid missing a point to open or close a position. So because you said we are struggling to enter to a spot an entry point. So this is where the more weighted moving average could be used. Okay. So yeah, exponential moving averages or weighted one over here, because we have to do the version, are more useful to help spot an entry And I should say that also very useful to spot a sudden shift. So in a case of a sudden shift for anything, because of news, breaking news, etc., a simple moving average will not help you spot that shift, but exponential will do, will indeed help you, because they are more sensitive, they are more, they provide greater significance on the most recent data points. They are very useful to help you spot sudden shift in the price movement. However, that comes with some disadvantages, right? They are less accurate than simple moving average, okay? Especially when they are used for long-term trends. Long-term trends, simple moving average are more helpful for long-term trends. Exponential are widely used for in the short term because they're more sensitive and fast. Also, exponential moving average are very useful for identifying support and resistance levels, and they are, I would compare them with simple moving averages, they are better on providing immediate support and resistance levels. Okay, that's why I don't know how you're using them. They are okay, so but the fact that you're struggling to find an entry point, it might be either the wrong moving averages or the fact that you're not using a combination of moving averages. Two would be ideal because they are the interaction to each other are very useful for entry points. So let's move on. Okay, we have done this. Let's move on. So what matters, what we need to rely on is not only whether the moving average is rising or any moving average, weighted one, exponential one, adaptive one, any of those, okay? Sorry. So whether a moving average is pointing up or down, that gives us indication of direction, okay? But what matters the most, or at least more than the direction, the identification of a direction of a bullish or bearish signal, is the crossovers. The crossover of two moving averages is not only giving us a sign of direction, but also give us a sign of momentum. The further apart the two moving averages are, the stronger the momentum, so the more the trend will last. The further they squeeze and they come to each other, the less the momentum, which means that the trend might reach to its end or it might even reverse. Okay, so that give us, so other than the fact that they give us direction, they give us momentum, okay? And if a moving average has been retested by the price many times, okay? So let's, I don't know, let me see. So for example, sorry, I messed my charts. I messed up with my charts because I was doing also some other stuff the last few days and I messed up with my moving averages, but where's my daily one? Okay. So for example, what's that? Okay. Actually, so Okay, it's not an ideal example. Okay, let's use oil. Why not? Let's use oil. The blue is the 50 and the red is the 200. Okay, we are in a daily chart. The fact that from June 2023 up to here, when it was broken up to October, late October, both of them were very, very good support levels, especially the 51. So we could see that it was retested once, twice. Actually, let me clear all this mess. I will put it in a different chart so you can see it. And I want oil. Oil, 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 or your, why not? Okay, never mind. What I'm trying to show you, but I lack out of examples right now. Should be my fault because I wasn't prepared for presenting some live charts, but whatever. If a moving average, in this case, I cannot find a very good example. If a moving average retested many, many times, okay, the 51 was retested here once, twice, here 3 times, 4 times. So the stronger the moving average is. 4, over here it was retested, broken but reverted back up, remain above it, retested, 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 and remain above it. The more the number of times it has been retested, the stronger the signal is, and the stronger that moving average, the stronger the support or resistance level is. So in this case, we have euro yen in a daily chart. We can see that the 50-day moving average was retested many, many times, even broken sometimes, but it keeps provided a very, very strong support level because it's an uptrend, so it's support level for euro yen. So if I change this one into 100, okay, that's even better in case that our also the 100 it was retested many times. It was retested 1, twice, 3 times, and that's it remain above it. So the more the numbers they have been retested, the stronger they are. Okay. So what that means? It means that if they are broken, significantly broken, I mean, this break to last, not like here that it was broken once and the next day reverted everything, retested once, the next day reverted, the retested one, the next day reverted, broken twice, the next day reverted. If the asset breaks it and it keeps moving lower away from it, that would be a very strong indication of a reversal of the overall long trend. Okay, that's why it matters whether a moving average it's been retested many times without breaking. Okay, because it's giving us clues of a reversal, of an imminent reversal. Okay, so let's move on. Okay, I want you to think about moving average as in aeronautics. So it's basically it's giving us, like in airplanes, the rate of a climb of an aircraft, right? Presents the rate of climb, right? Presents its vertical speed, the positive or negative rate of altitude change with respect to time. This is what how the aircraft's rate of climb is. Okay, so in some countries, I don't know where you're placed in the world, but sometimes some countries, this is usually measured in feet per minute. But I think it's commonly expressed as meters per second. So the best rate of climb speed gets you the most altitude per unit time per feet per minute in this case. So when you want to get to cruise altitude quickly for a maximum efficiency, you will aim for the best rate of climb, right? So you spend the least time at lower, less efficient altitude, right? And this is what I was talking about. However, the best angle, so this is the best rate of climb, and here we have an example of the best angle. So the best angle of climb speed gets you the greatest altitude per unit of ground distance. Much faster. So think the vertical line as the time, right? So look at that. That aircraft that had the best angle, it managed to be at that area much faster in less time that these aircraft in which had a best rate of climb but not an appropriate angle. So the angle was much smaller. So they both bridged to the same level, but the first one that had the best angle, it bridged that area, that level faster. Now, I want you to remember something. Yeah, indeed, this is a case, but it doesn't mean that the best the angle, the longer the trend will get. Okay, so even though with the same speed it breached that level wanted with a better angle, however, that one is giving a greater altitude gain in the short time. Okay. So the angle. So why I'm saying all this is because I want you to understand that. I want you to interpret this as with the moving averages. So a moving average that is in a sharp angle. So like a sharp angle. Like this one. Let's focus on the red and on the. Let me just delete all this. Here. Okay. Sharp. Okay, come on. Okay, here we are. Let's focus here. Okay, here. That I will draw. These yellow and green, okay, they are another moving averages that I use. It doesn't matter what kind of moving averages. What I want you to monitor is the slope, the angle. These had a much greater angle than the blue one. Yes, indeed, greater angle, indicating that right now we are to the upside, but that will not last for long. This angle will not last for long. Indeed, if they flatten here while this one had a small tiny slope but keeps rising and rising and rising. So this shows that the uptrend will last for long, while this one presents that there is a sharp rally that is limited. You are not audible? No, I am audible. I think it's your part. Let me reply to Abdullah. Um, uh, yeah. So the sharper the slope is, the sharper the angle is, indicates that yes, there is a rally, there is or a drift, depends on where they are pointing, but it might be, it might not last for long. But if a slope is slowly increasing, that gives the impression of sustainability. How can I say that? Okay, so angle matters because angle matters. Okay, because it will give that indeed we're gonna have a greatest altitude in a shortest horizontal distance, while if there is a smaller angle but with a best rate of climb, that gives us that we're gonna have that we're gonna give us the greatest altitude gain in the short time. So volatility is measured, guys, by taking the distance between. Also, extra on that, I did mention that is used for entry points, used to find a momentum, it used to find support and resistance levels, direction, and volatility. But I didn't explain how you can measure volatility. So volatility is measured by taking the distance between the moving averages and the price. Okay? Let's see. Can you see this one here? The far away, you see this sharp, from this chart, let's focus a bit on this chart. So we can see that we are in a very volatile asset that we are getting a high volatility because the more the asset, the price action is moving way far away from the average, the moving average is way away from the price here. So it was sold off, and that ends to have all this distance from the price, from the moving average. So this is the moving average, and this is where in this case, where our price stands. So this gives a very high volatility in the market. And as we move on, you see, as we move on, slowly, day after day, or session after session, depends on which time frame we are, the price is getting closer and closer to the moving average. Actually, the moving average is getting closer and closer to the price, and it shows that the volatility detected. However, if the volatility is if the moving average is very close to the price, that means that there is a low volatility, a fall of volatility. Why that matters? Because in this case, the moving average cannot help us spot an appropriate support or resistance level. Okay? So remember, everything is based on statistics. Okay? So mean aversion, which is the concept of moving average, the significance of using moving averages, okay, is because this variable, okay, this variable, it helps us to figure out how the price reverts away from its mean value over a period of time. So if the asset is far away from the moving average, that means that eventually it will come closer to it. While if it's close to the price, or if it's on top actually of the moving average, that indicates that it will start moving away from it at a reasonable distance. So whenever, this is the same for financial markets in general, okay, any forex, currency, etc. The traders use this concept of statistics of mean aversion, which in this case is used by moving average, to identify whether the asset price is away from the moving average with the anticipation that it will get closer to it, and if the price is on the moving average, then that indicates that whether it will move away from it and in which direction it will move. Okay, this is what matters. So whenever a price deviates too far away, like here, from its mean price, okay, in this case our moving average, traders can take advantage of this phenomenon and find trading opportunities. So what I mean by that, it means that the traders, okay, in theory it sounded simple, but it means that in such an extreme occasions, okay, the fact that it's sharply in a day, well, so far away, indicates for traders that should therefore some short-term buying the dip opportunity of the belief that they will start moving closer. Limited one though, okay, limited one. Or if the asset retest and actually broken a moving average, so it's very close to it, on the fact that it actually again they need to spot based on the low volatility when and whether the asset will get closer to the price. So let me rephrase it. Let me make it simple. I know mean reversion sounds a bit too simple than actually is, but in this case, traders, you guys, need to have an adequate practice before you can use this approach. As we have outlined earlier, mean reversion is predictive in nature, right? So this brings the risk that price can remain at this extreme value for a prolonged time of period. So in the long term, this means the fact that it went far away from the moving average, it means that in the long term or in the medium term, the asset will remain down. right, will remain. So in this case, if I focus on this example, remember, the fact that it went far away from the moving average suggests increased volatility. So what increased volatility means, right? It means that it wasn't once off, that this sharp volatility could keep the asset at these extreme levels. This is in the long or medium term. In the short term, though, there will be the need of getting closer to the moving average. So there are two ways to be used, either for going against the trend on the belief that it will try to get closer to the moving average in the very short term, but in the long term, in the overall outlook, it will remain at this extreme value for a prolonged period of time. So that means that if we are medium or long-term traders, we could, in this case, we could have opened a sell position with the indication that it will remain down for a prolonged period of time. But if we wanted to, we are intraday traders, we wanted to benefit on this sell-off, we could have opened a short, for a short time, in a short time period, a long position on the belief that it will try to go closer to the moving average. Okay, be careful, it's not easy. Breath. Actually, let's move on. Okay, I don't want to. Okay, these are some setups that you can use. Okay, some setups that you can use: alternative or simple or exponential moving average, the default settings. So the default settings in MT4 and MT5, okay, the default settings. So if I just show that the moving average applied to the close price, okay, applied to the close price. Even if I drag and drop the moving average over here, you see close price. So here there are some amendments that you can use, but always make sure that it satisfies your asset and your time period. So what I mean by that, you can, okay, other than the simple and exponential, the exponential moving average, we have the weighted moving average, the variable weight moving average, and so on and so forth. So, however, shall I mention the shift now or not? Let me just, okay, by default it's on the closed. Okay, I'm gonna put it on. Gonna check whether the simple, this is the simple, okay, this is simple. Simple 100. Let me just put, sorry, I'm trying to bridge to a point, that's why I'm supported. Okay, that looks much better. Over here, I use 20 exponential. Okay, we'll put it in blue. And I'm gonna use also a 30 exponential. Let's see. 51. Okay, why not? Okay, 20 and a 50, okay, in a daily Doral index. Now, look at that. The asset move above my moving averages. Actually, the first time that it came above and close above my 20 exponential moving average was on the 27th of June. It finally broken the 50 exponential moving average on the 1st of August. So now is above both of them. But, okay, it was above it, indicating that we might have the beginning of an uptrend. So look at that. We were like here. We were here. Okay, we were here. It drifted. Oh, come on, Andrea. Up, up, and it was a question mark raised here whether it will. The trend is changing, and we're gonna have a new uptrend, or whether this uptrend will extend it further. Okay. Indeed, it provides there was a correction, it provided support, the asset didn't manage to move below them, and then the bullish cross between the 20 and 50 came, confirming that we have a, a an uptrend. An uptrend confirmed that will last for quite some time. If we consider the distance and the fact that the distance between our moving average, we're getting far and far away. The far away they are getting, the more the far away they are getting, the more the trend will last. So it's not only the distance between the price action and the moving average, it's also the distance between the two average as such. So we had a bullish signal here, actually bullish signal number one here, bullish signal number two here, and then the confirmation that we do indeed have an uptrend that will last for quite some time. It came with the bullish cross over here of the two moving average, and the fact that they are moving away from each other, it shows that it will last for long, which indeed it lasted. Okay, and then now they're squeezed, indicating that we are either it ran out of steam, so we might see a downtrend sooner or later, but they still hold. Okay, they still hold. So there is a range in market. They are both flat, indicating indecision. But yes. So let's get back where I was. Now, in order to make the things a bit more complex, there is also the option, other than different moving average calculation option, which in MT4, MT5 we have simple, exponential, smoothened, and linear weighted ones. We also have the option of a shift. Okay, of a shift. By the way, okay, of a shift. Let's do the shift first, and then the others. So I will use the same indicators, okay, same, but with a shift. So we have, we're gonna use 50 exponential. I will put it in yellow with a shift. That was too tiny. And I will use also 20 green. So look at that. Look at that. Let me double check that I put it properly. This is a 20 with a shift, and 20 without a shift. Okay, just a second. Oops, sorry. Sorry, just a second. So the shift, guys, what the shift is useful for is useful for indicating the potential, it gives an indication in advance of the direction. Okay, so let's see, let's check it together. Okay, so here we had, okay, they have crossed at the same time, but this is not what matters actually. What matters is that back then, I don't know how clear it is right now, but actually let's do the present one because you cannot see it. You cannot see the shift here. You can see it now in the present. So here, what that means, it gives us the interpretation that this ranging market between 105 and 106, it will last a bit longer. Okay, so it gives us a clue on whether hopefully Abdullah left, it didn't manage to hear us. The shifting of a moving average, in particular in a certain period of time, actually you could increase it even more from what I did, okay? But so what that means, it means that we are shifting the moving average ahead of time, or in general for a certain period of for a certain amount of period. Okay, so why is useful? By changing, by shifting by 5 days, by 3 days, depends, it's up to you, depending on the time frame that you have, on whether you have tested in the past and it makes sense. Okay, that's pretty much it. I mean, if you saw in the past performance it was useful, you can use it. If not, don't use it. But the shift ahead of time, forward or backwards, by the way, I could have set it backwards. Okay, see, I can turn it backwards. So with this way, I will have known that 5 days in advance that over here I had a bullish cross. So 1, 2, 3 days in advance, 4 days here. So I will have a signal 4 days in advance. Here it flattened last week, so we have known that it will enter a ranging market soonish. So it's a displaced moving average. It's not easy to be used, okay? But it's like it has all its values shifted forward or backwards. So you need to check whether it makes sense for your asset and your time frame, okay? It's a very difficult moving average. It is called displaced moving average, or moving average with shift if you prefer. So it's not something easy to be used, but what's the aim on using something like that is to have a better forecast of the trends, or better fit for the price movement of an asset. Okay, so this is why it's used. It's not something that is easy to be used. It's not something that it always works good, okay, but it helps determine trend direction, or even reversals, and even provide ahead of time, and even provide, if it's used backwards, and even provide trade signals. So it helps pretty much on forecasting potential support and resistance levels. Okay. So, um, I would like to show a better example of it. Let me see. Don't have with a shift and no shift. With or without shift. Cool, I have one. Oh, fine. So here we have exponential moving average, euro dollar 4-hour chart. So the blue one is without shift, 10 exponential moving average. And the other one is with a shift of plus 10. Okay, and look at that. So the simple one, without the shift, it was giving us a nice resistance levels, perfect, fine. There was a bearish cross between each other over here. So that was a confirmation that we are in an uptrend, and the asset was keep moving lower. The moving average without the shift, it was giving us a nice resistance level. All good. So you understand that at any swing high, it was a nice opportunity to sell or to add to your existing sell position. So every time that was retested, it was a nice chance to add further to your selling position, so on and so forth. But in this case, the distance, the fact that they were both pointing lower, right? And the fact that we had our exponential moving average, the normal one without a shift, and the other one with a shift, and they both pointed lower, and there was a constant or even wider, not narrow, wider distance between them, and that distance was held and held and held. It was an indication that, okay, our trend is not running out of steam. We still have, it's still going down, it's still going down. So if at some point you are the exponential moving average with a shift, and the exponential moving average without a shift start coming closer and closer right here, or even cross, this is when you should close your positions. This is the significance of moving average with shift. Let's get back to life. I will keep the 20. You know what? I'm gonna get rid of the, where is it? Come on, of the 50. So what I have over here is the 20 with a shift, 20. But I have it backwards. Let me put it as it was, plus 5. So on forward over here, perfect. So what I have over here, they both cross each other. The price was above them, right? Look at this beauty. And it started moving above them. And they started both pointing higher, right? Nice. And they had a constant distance. Nice, nice, nice. Sometimes they were squeezed, but nothing really serious. They both pointing up, both pointing up. So we were okay that yes, this uptrend still holds, this uptrend still holds. But eventually, they come so close to each other. And that was, do you know what that was, guys? Do you know what that was for someone that opened a long position here on the breakout, or any time afterwards that I noticed this uptrend? Do you know what is this about? The fact that they came so close to each other in contrast with the previous performance. Do you know what that is? This one. What is this? Come on, anyone? Anyone, do you know what that means? Guys, come on. I know that you know it. Yeah, come on. Anything. Anything that comes to your mind. Do you know what that is? It's a sign to close any long positions that you have. It's a sign that the sentiment is changing. It's a sign that the uptrend is running out of steam. Exactly, Victoria. Not a reversal yet, because we need to see both of the price moving below both of them. And not only that, we need to see them developing, because here the price came below both of them, but they are both flat. You see, they are both flat, so they don't give the impression, they are not pointing down in order to confirm us that yes, we are in a reversal, a new trend has started and it's a downtrend. No, it's not a clear reversal sign, but it's a clear exit point of the pre-existing long trade. Okay, exit point. Let me shift further my moving average to see if it gives even better results. No. In this case, for dollar index daily chart, the +5 shift, it was just fine. It was just fine. Clear? It was an exit point. Now, what we are waiting for dollar index? Price is below both of them, right? Yes, but they are both flat. They don't point down. So we need to wait and see whether this bearish signal, this crossing bearish cross that we have seen, it will last. And in order to confirm something like that, we need to see the moving average both starting pointing lower. So it's the slope that we discussed earlier. The slope matters. If the slope is weak and if it's flat, you don't have a trend. Okay? Okay, let's move back. This is the disposable moving average or center moving average. Basically, the use of the moving average, any moving average that you want, as long as they have the same parameters, and the only thing that changes is the shift. Okay, always make sure that is giving you appropriate signals, right? Go back and see. Okay, they cross and we had to close over here. Okay, not bad, not good. So check, go back and check. Is it giving you too late signals? Is it giving you early signals, too early signals, and so on and so forth? Okay, always check. Now let's get back, because we skipped many slides in order to jump to the shift. So also because basically we are over an hour, I run quickly to the examples. Okay, another way of a more advanced moving average is the use of moving average, but with different, applied to different prices. Apply to, let me just, come on. That webinar should have split it to two. I'm sorry for that. So you see, as you notice in my slides over here, we can apply the moving average not only on the close price, which is the default one, but we have the option of open price, high price, low price, or mid price, typical price. So taking the average of the high, the low, and the close, or the average of the high and low, of the average of high, low, open, close over 4, So okay, these are more advanced ones. So we have the option to change these as well. Okay, why changing them? That's another setup that you can use. With this way, okay, with this actually, okay, let's take it by step. If we use, let's say, the low of the price as an input of the moving average, we use the low instead of the close. Okay, this will, if we are in an uptrend, okay, it makes more sense. Assume that you are in an uptrend, okay? If we are in an uptrend, okay, and we've seen our prices dropping below moving average, then using the low of each candle as an input for the moving average may make more sense than using the close. Why is that? Because with this way, the moving average is only breached when a price bar penetrates the average low of other price bars. So the same concept apply during downtrend. So it makes more sense to change our moving average to take into consideration the highs and not the close price. By the way, this is not a requirement, okay? It's only an example of how settings can be alert to achieve an alternative insight. Okay, the difference is usually very, very minor, but if you're using moving average as a trade signal indicator, then the input data will have an immediate impact on the profitability of these trade signals. So let's see an example in order to understand what I'm talking about. Okay, so over here, let's focus on the first part, okay? Over here, we have used the same moving average, exponential moving average, okay, in 4-hour chart, 20 period one actually here. But the blue was, in the blue, we have provided as an input the high prices. So over here, apply to high, okay? Apply to low, apply to close, and so on and so forth. So here, the input, the blue has input the high prices. The red is the default one with input having the close prices, and the green has input the low prices. Okay, we notice we use all these three, okay, together. Are you with me? Are you with me? Or I lost you? Okay, so far the price was moving below the 3 moving average. Eventually, it started retesting them until here, when I have my bullet point 1, it closed above all 3 of them. So the fact that it closed above all 3, it could have been an entry point. Entry point for which direction? Does anyone know? Up or down, long or short? Every time that we have seen the price closing above all of our 3 moving average, if we are using 3 moving average with the same period, same method, exponential in this method, but different input data, high, low, and close, move above all 3 of them indicates a long position. Okay. And when we're gonna have an exit point? Only if we see the price closing, not retesting, closing, a full candle closing below all three of them. So if someone, anyone, spot this one, even if he didn't spot it, maybe he didn't spot it on time, but he spotted that one. You see, they retested but above it. So even if it enter later, it doesn't matter. This area somewhere here, this ideally was the very first indication you will have been at the beginning of the trend and etc. It was ideal. That one was an entry point for the upside. When you should have closed your trades in this example, here or here, but that was a more confirmed one because we had two consecutive candles below all moving averages. Close, you see, the close, it matters, not whether it was retested. Here it was retested, but the body was above my green, so it didn't manage to close up below all of them. It closed below all of them here. So that was the exit of this long distance move. Can you imagine how much you could benefit if you had spotted this entry? And it's not only that, guys. This is calling for selling signal as well. That could have been an entry for a short position with closure. Let me find the closure here. Understood? Yes, no? This, I know that's a bit more complicated, but you see how well it satisfies euro dollar in 4-hour chart? Brilliantly satisfied it. Okay, it's already 2:30 and I haven't even showed the half of them. I have more examples. Over here I have 6 exponential moving averages, 3 10-period ones with close, high, and low, and another 3 with 8-period ones, high, low, and close. Okay, obviously I don't want you to try so complicated ones. I want you to get familiar with at least these 3, and then to add more if you have to. The fact that we have used 2 over here is just to add, to spot any additions of the existing trends. So you see, here we had the closure of all the 10-period moving averages. Okay, so that was a selling point. I forgot what I wanted to say. The fact that the so that was the basically by combining 2 different periods, it gives you positions in order to add to your existing position, and also it gives you indications of closing partially your position if something changed. So in this case, let's take this for example. Long trade above everything, bam, 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 bam. But over here, it closed below for the first time, below all my, actually below the pink, blue, green, sorry, pink, blue, and gray and red. Below 4 out of 6 indications. So here it was the indication that you can either partially close your position or completely close your position because something is changing, momentum is changing, reversal indicates reversal as well. Okay, now, you close your position, but you needed to figure out when to enter, when you want to spot on time the most appropriate time to enter the new trend. So an appropriate time to enter the new trend will have been, okay, sorry, wait me, here. Here we have the crossing. Other than the fact that we have 1, 2, 3 consecutive candles below 4 of them, we have also the crossing of the 10 with the with closed data, and we have also the below the 10 with the input, with the high input one. So that was another entry point to the downside this time. It's a more complicated examples. I don't want you to try it if you're not confident with the previous example, okay? As another example, in this case, we used the mid price. So we used this one, okay? We used the mid price with the normal one. So just so this is a daily euro dollar. So 21 exponential moving average and another one daily one with median price. So let's do the same, but this is euro dollar. Okay, let's keep the example. So you see the green one was the median price one, while the other one, it was the with the closed prices. So you can see the one was more sensitive to the price. It actually followed the price. Okay, so any bearish cross that they had between each other, it was a selling point. Any bullish cross, it was a bullish point. Bullish, okay, bearish for limited, bullish, bearish. So it's a very fast environment. So this is very useful for any one of you that is a short-term trader. It's very, I'm sorry, I'm running. I know that I'm running. I'm not fully covering the examples, but we are already 1 hour and 40 minutes live. So I think I'm going to call it a date. You have the slides. Try to study them a bit. And I will try to cover another webinar with this. I underestimate this webinar. I underestimated a lot because there are many, many examples that are useful. So I'm going to call it a date and I will try to find time to repeat it, okay? The 3 moving average, are they in the same period? You are referring to this one? Yes, they are. The only thing that changes is the input price. So with blue, we use the high one, with red, the close, and with the green, the low prices. Guys, I need to call it a date. I'm really sorry. It seems that all this needs 3 sessions, not 2. And I spend a lot of time on the basics once again. Study with the examples. Some are very complicated, I know that. But and it's something that you can try later on if you feel very, very confident with the more simple versions. But yeah, there are some they are very, very useful, especially for intraday traders, such as this one. The combination of a normal of the same time moving average, but the one with input the mid price and the other one with input the median price. So well, I will try, but anyway, if you see on the webinar schedule moving average again, that will be it. That will be it, okay? So if you are getting our emails or watch our social medias in which we advert webinars, once you see moving average, it's me trying to cover what I left behind today. Okay, but the handout is there, so feel free to have a look at it. Okay. Barak is asking what's the difference between MT4 and MT5. Okay, it's a more it has more indicators. This is MT5. It has more indicators. It has more time frames. Other than the 5, 15, 30 minutes, 1 hour, 4 hour, daily, weekly, and monthly, it has 2 minutes, 3 minutes, 4 minutes, 6 minutes, 10 minutes, 12 minutes, 20 minutes, 2 hours, 3 hours, 6 hours, 8 hours, 12 hours, many time frames, many time frames, more indicators. Okay, more indicators, in general, more tools. And if you are interested in moving average, for example, you can see, okay, moving average is the same, basically, same options, but I noticed, where is it? Come on, where is it? There are moving averages of oscillator. Okay, I think we have this also in MT4. Triple exponential moving average, something that we don't have in MT4. And I noticed somewhere that there is by default a weighted moving average without us amending the setup and etc. I'll find it right now, but yeah, more indicators, more time frames, and a more friendly, user-friendly environment. You can see there everything is with icons, colorful. It's a bit of an upgrade version of MT4, to be honest. So it's nothing bad with MT4. I'm used to presenting MT4, so I'm struggling to go into MT5. I should though, I should. But yeah, double exponential moving average, you see there by default, some adaptive moving average by default. So you see there are many moving average that are by default there without you changing them manually. Okay, so yeah, so that's the only difference. More moving out, more indicators and more time frames. This is the main difference. There are others. There are more expert advisors as well, and a more user-friendly environment. I'm afraid you need to open a new account, MT5 account. Okay, it's not just the same account, but in both platforms. Did you? No, there's no way not to work. Are you using? Maybe you're using the credentials of the MT4. That's why you need to open an MT5 account. So let me just show you. Have you discussed this with support team, Thewell? Yes, good to. Why not? Trying to yeah, of course, try it in a demo account. It's the same thing. It's just it has let me just, where is it? My accounts, my wallet. Just has some extra yeah, extra options, nothing more than that. Okay, so you need to download Meta 5 first of all. Okay, you need to download it from the website and to open a demo account with that until you feel ready to open a live one. Okay. Okay. So yes, please, we have a live chat on the website 24/5. So yeah, feel free to first of all download it. Okay, open a demo account in MT5, and if you need any help, just say it out loud. Okay, guys, I need to call it a day. Thank you very much for attending. I will try to resume once again. Have a look though on the examples, please. And I'll see you again next week. Thank you. Bye bye.